All right, let's jack in. You know, the market, it has an official narrative, a clean, polished stream of code that's supposed to tell you where your money's going. But if you look really close, right between the lines of data, there's a flicker, a ghost in the machine, a multi-billion-dollar glitch they're all trying to pretend never happened. Okay, let's get into it.
So, here's the official story, fresh off the press from Goldman Sachs. The suits and their glass towers just dropped their big investment outlook. And it's this shiny, perfect roadmap to 2026. They say they've got it all figured out. The big catalysts, as they call them, are going to be AI spending, a new wave of deregulation, and of course, a little deal-making. It's this neat, tidy little world where growth is always predictable and the system, well, it works exactly as designed.
But here's the thing about that glossy forecast, this official narrative. It has a massive blind spot. It just so happens to memory hole a pretty critical event, a moment when the system didn't just bend, it actually cracked wide open. Yeah, I'm talking about a multi-billion-dollar ghost from 2021 that the smart money is really hoping you've completely forgotten about.
So let's rewind the tape. Let's go back to the GameStop event of January 2021. Now, this was not just some meme stock rally. No. This was the moment a decentralized swarm of retail investors found a bug in the market's source code. They exposed a vulnerability that the architects of the whole system never, ever wanted you to see. Just let that number sink in for a second. $6 billion. That is not a rounding error, my friend. That is the amount of capital that just, poof, vaporized from short sellers who were betting against GameStop. And get this, in one single month. This wasn't just a market fluctuation, it was a financial earthquake. It was the first real proof that this glitch wasn't just a theory. It could literally bleed the suits dry. So, the most important part is how the system reacted when it was really under stress. First off, you've got a stock with short interest and an impossible 114% of its public float. Think about that for a second. More shares were shorted than actually existed for people to trade. So when the pressure got intense, what happened? Brokerages like Robinhood literally turned off the buy button for retail. And behind the scenes? Well, Citadel, a market maker that just so happens to process a huge chunk of Robinhood's trades, pumped billions into Melvin Capital, one of the hedge funds getting absolutely squeezed. The conflicts of interest were just screamingly obvious. Congress held some hearings, yeah, but the core mechanics were never fixed. It's like they put a Band-Aid on a gaping wound and just pretended the patient was healed. The glitch was logged, but the bug was never removed from the code. And look, even Congress knew something was deeply wrong. They called their hearing Games Stopped. They acknowledged this collision of forces. But they treated it like a traffic accident, not a fundamental design flaw in the car itself. You know, the questions were asked, but the underlying engine of the market, completely untouched.
So while the suits tried to move on, a community of retail traders, the apes, they went back to the crash site. They started reverse engineering the glitch, and they developed their own thesis. A counter-narrative about how the market actually works, not how it's supposed to work on some PowerPoint slide.
And right at the heart of this ape thesis is a concept called naked short selling. Put simply, it's selling a share you haven't borrowed and you haven't even confirmed actually exists. It's the financial equivalent of a casino just printing its own chips to cover bets. This creates phantom supply, what they call infinite liquidity. The system works just fine, until everyone decides to cash in their chips for real dollars all at the same time.
And this gets to the absolute core of the vulnerability. When you buy a stock through your broker, you're just the beneficial owner. What you get is an IOU. The actual share, it's held in street name by a central depository, the DTCC. And this is what allows your share to be lent out to short sellers, a lot of times without you even knowing. The countermove is direct registration. This puts your name directly on the company's books. The share's yours. It cannot be lent out. It's the difference between having an IOU for a gold bar somewhere in a vault and holding that actual gold bar in your hand. One is a promise, the other is possession.
So how do the apes exploit this? It's a deceptively simple three-step play. 1, buy the stock. 2, hodl. That stands for hold on for dear life. You don't sell no matter what. And 3, this is the kill shot. DRS. You directly register your shares. Every single share that's directly registered is like a real gold bar being pulled out of the casino's vault, exposing all those phantom IOU chips they've been printing. Now, you might be sitting there thinking, okay, but that's just one weird stock. But the GME glitch, it exposed a much deeper systemic fault line. What happens when information, or even panic, can spread at the speed of social media? Well, you don't have to look any further than the collapse of Silicon Valley Bank. This wasn't a slow-motion failure. This was a digitally fueled bank run, triggered and amplified by tweets and group chats. It was real-world proof that a viral cascade of information can now bring down a major financial institution in a matter of hours, not days or weeks.
And listen, this isn't just me speculating. An academic study on the SVB collapse actually quantified it. They found that a high volume of Twitter messages about a bank was a direct predictor of hourly stock market losses. Social media didn't just report on the risk, it became a catalyst that actively amplified the underlying balance sheet problems. The code went viral.
So let's connect the dots here. We've got the unresolved issue from 2021, the potential for millions of phantom shares in the system, and now we have a new reality, digitally accelerated financial contagion. So what happens when the next GME-style glitch goes viral? That right there, that is the hidden danger that the suit's glossy reports don't ever want to talk about.
Which brings us to the quant ape synthesis. It's time to put the official narrative of a stable market right next to the data points that suggest a hidden fragility, the cracks in the foundation.
Let's look at these cracks, and we can even use Goldman's own data. They mentioned $360 billion in private credit loans. Now, this isn't spread out nice and neat. It's concentrated into 7 big banks. It's opaque, it's hard to value debt. I want you to think of it like a hidden weight on a system that's already showing some serious stress fractures.
And that's just for starters. Go ahead and add another $850 billion in commercial real estate debt that has to be refinanced by 2026. This isn't some new growth we're talking about. This is old debt coming due in a high interest rate world. It's another fault line just sitting there waiting for the right tremor to set it off.
So here's the crucial point. The entire official outlook is built on a foundation of growth and stability. But what happens if another glitch, another GME-style event, puts unexpected pressure on that system? What happens to that mountain of commercial real estate debt if the glitch creates a liquidity crisis and the banks holding it suddenly need cash? That is the synthesis. The glitch isn't the bomb itself, it's the potential detonator for these much larger systemic bombs the suits are sitting on.
So, what's the takeaway from all this? The goal here isn't to try and predict the next crash. It's to give you a new way to see the market, to understand your edge in what is, at the end of the day, a casino. And let me be crystal clear. None of this is financial advice. We're here for educational banter and a little speculation. This is an analysis of information asymmetry. The system is built on rules. And yeah, the house has an edge. But your edge, the retail investor's edge, is understanding the glitches that the suits are trying to ignore. The real battle isn't about one stock. It's about who understands the code versus who's just blindly following the official narrative.
Look, the suits built this complex, interconnected world on layers and layers of code and rules that they don't even fully control anymore. Social media has accelerated the feedback loop to near instantaneous speeds. The system is just more fragile than they want to admit. So the real question for you to chew on is this: who finds the next bug? Let me know what you think down in the comments.
We are watching this chart like a hawk. While you wait for the next candle, grab your free gear. Sign up for Public to get $20 in free assets. Check Webull for that BTC promo, or grab your NVDA stock on Moomoo. Links are in the description. Smash the like, subscribe to the tribe. Apes together strong.